I borrow my money to pay bills every month on purpose, not because I'm broke. I actually have a solid income, not because I can't afford my bills, because I can. I do it because borrowing money to pay bills, when done right, is one of the most powerful financial moves a regular person can make. Welcome back to another episode of Almost Wealthy. I'm John, and in this channel is my real unfiltered journey to building a portfolio I can live off of for the rest of my life without selling a share. Today, I am opening the actual spreadsheet that runs my entire financial strategy. It's called the Buy, Borrow, Die Bill Stacking Plan. 10 phases, 10 bills, one very specific plan from where I am now to a point where my entire paycheck goes straight into building wealth. And the spreadsheet is available to you in the link in the description. Stick with me because by the end of this video, the whole thing is going to make complete sense. If you're new here, let me give you a quick version. The strategy I'm using is called Buy, Borrow, Die. This is a big name, but a simple idea. Step 1, you buy stocks, specifically stocks and ETFs that pay you more every month. Those payments are called dividends. Think of the dividends like a paycheck from your investments. The more stocks you own, the bigger the paycheck gets. Step 2, borrow against those stocks instead of selling them. Here's the key insight most people miss. Your brokerage, the app that holds your stocks, will let you take out a loan using your portfolio as collateral. It's kind of like a home equity loan, except instead of your house, you're borrowing against your investments. The loan doesn't even count as income. The IRS doesn't even touch it. Your stocks keep sitting there, growing and paying dividends while the loan covers the bills. Now on to step 3, you die. Okay, that might sound harsh, but here's what it actually really means. When you pass your portfolio on to your kids and grandkids, the IRS essentially resets the clock on any gains. All those years of growth, the taxes on it disappears. It's built right into the federal tax law. Today, we're going to focus on step 2. The reason why this works for me specifically is number 1, my portfolio pays me 5.33% a year in dividends. My loan charges me 5.65% a year in interest. The gap between that is 0.32%, means I'm earning more from my investments than I'm actually paying on the loan. Every single month, I come out ahead, and that's the engine. Just know that my dividend percentage is dynamic, so it could change because 3 months ago, it was at 6.44. So just know that these dividend numbers fluctuate, but as of right now, as I checked before this video, it is 5.33%. So before we get into the spreadsheet, here's where most people hit the wall when they first hear about this strategy. They think, okay, I'll borrow money for all my bills right now, and I'll let the investments cover it. And that would be a disaster because the amount of money you can safely borrow depends on how big your portfolio is. If your portfolio is worth $10,000 and you try to borrow $3,000 a month, the math falls apart. Your loan balance will pile up faster than your investments could grow. And if the market drops, which it will eventually, you could get a margin call. And that's when your brokerage tells you that the loan is bigger relative to your portfolio, and you have to pay some of that money back immediately, basically forcing you to sell your stocks at the worst possible time. That will be a nightmare scenario. So the question isn't whether your strategy works. It does. I've been doing it. The question is, how do you do it safely? And my answer is one bill at a time. So now let's go into my spreadsheet. This is the Buy, Borrow, Die Bill Stacking Plan. I built this spreadsheet from scratch to map out exactly how I phase into this strategy safely. Let me show you what you're looking at. Each row is a phase. Each phase has 5 things. The portfolio target, which is how big my portfolio needs to be before I add this bill. The bill being added, which expense moves from my paycheck to the loan, the total monthly borrow, all the bills on the loan combined, the dividend coverage, how many times over the dividends can pay the loan interest, and the paycheck freed up. How much of my take home stops going to expenses and starts going into investments. 10 phases, 10 bills. Let me walk you through every single one. So before we get started, I want to let you know that these numbers on the screen are conservative. They're kind of a ballpark figure of where I need to be on each phase. So if you're like running the calculations, it doesn't calculate right, then I just want to let you know that these are very conservative numbers. For an example, on phase one, it says I should make $24 a month, which is true. But for the month of March, this month, I made $32. So I made a little bit more than 24. Like I said, it's a ballpark of where I need to be. But you can also download this spreadsheet and make the numbers how you wish. But for this example, like I said, I don't like to be super accurate. I just like to be very conservative. So if I'm above that number, I know I'm on the right track. So let's talk about phase one, which is the $6,000. My first bill was my AT&T phone bill, which runs around $98 a month. Portfolio target, $6,000 with a 5.33% yield. I'm generating around about $24 a month. The loan for $98 of interest is around $5. My dividends covers about 3.7 times over that, meaning if something went sideways, I have a big cushion. This phase sounds really teeny, $98 a month, but this is where psychologically this kicks in for me. And this is where I'm at kind of like right now. The moment the bills stop coming out of my paycheck and start coming from my loan, something really shifts. You realize the strategy is real. It's not just a spreadsheet anymore. It's actually working. And that feeling is what keeps you going through all the phases. Once you get started and you start seeing it, you're like, how can I get to these phases faster? Now on to phase two, $10,000 portfolio. Next up would be my AT&T internet bill, which runs about $100 a month added. Total on loan at that time will be $198 a month. At 10K, I'm generating around $40 a month in dividends. Interest on the loan is about $11 a month. The coverage is 3.2 times over. Still very comfortable. 2 bills down, 8 to go. Phase three, $14,000 portfolio. Next up would be my energy bill, which runs about $155 a month. The total on borrow would be $353 a month. Dividends at 14K will be around $56 a month. Interest on the $353 would be $20 a month. The coverage is 2.5 times over. You'll notice the coverage dips a little as the bills get bigger. That's normal. The key is never drop below 2x, meaning my dividends always cover the interest at least twice over. That's the floor I don't want to go below. Next up is phase four, $20,000 portfolio. The next bill that's up on that phase will be my car insurance. That's $88.33 a month. Total borrow would be $441.33 a month. On that 20K, I'm generating about $80 a month on dividends. The interest on the loan will be around $24. The coverage will be 2.8 times over. And you know, this is another bill that quietly drains your paycheck. So moving that money over to the loan will start compounding instead. Phase five, $30,000 portfolio. The next bill up will be my energy bill, which runs around $175 a month. The total borrow would be $616.33 a month. This is where it starts feeling significant, over $600 a month, but my portfolio at 30K is generating around $120 a month in dividends. The interest on the loan will be around $34 a month. The coverage is at 3.0 times over. The portfolio is growing faster than the bills. Phase six, $42,000. This is where I'll add my fitness bill, which is around $159 a month. Total on borrow at that time will be $775.33 a month. At 42K, dividends are about $168 a month. Interest on that will be $43 a month. The coverage, 3.4 times percent. This one feels good. This one will be good to move. Health is important, but that doesn't mean it has to come out of my paycheck. That's supposed to be building wealth. Phase seven is next, $56,000. This is where I will put pretty much all my subscriptions on the next bill, which run around $144. The total on borrow around that time will be around $119. My portfolio at 56K is generating $224 a month in dividends. The interest on that will be $51. The coverage will be 3.8 times over. The coverage ratio keeps improving as the portfolio grows. That's compounding effort working at a real time. And the bigger the portfolio, the more cushion I have. Phase 8, $80,000. The next bill up will be my house cleaning bill, which runs around $273 a month. Total borrowing will be $11,200. At 80K, my dividends are hitting around $320 a month. The interest on that will be $66 a month. Coverage 4.2 times over. Notice what happened. I went from 3.7 coverage at phase 1 to 4.2x coverage at phase 8. Even though I'm borrowing way more money, that's because the portfolio is growing faster than the bills are being able to be added. The math gets better, not worse. Phase 9, $112,000 portfolio. This one is big. This will be the mortgage, which runs around $1,600 a month, just the mortgage alone. Total borrowing jumps up to $2,800 a month. That phase nearly doubles the loan balance at one step, $112K. At that portfolio size, my dividends are running around $448 a month. The interest on that, $2,800, will be $156 a month. The coverage is 2.5 times over. But I want to be honest here. This is the phase where I'm going to be most careful about. The mortgage is a big number. If the market drops 40% while I'm in phase 9, my LTV, loan to value ratio, will spike. And then that's when the margin call becomes a real possibility. My protection is staying well above 112K target before I flip the switch, and keeping a cash buffer that can cover 2 to 3 months of loan interest no matter what the market does. Now, last but not least, phase 10, $145,000 portfolio, the last phase. At the time, I put daycare, but it will probably be school, which will run about $550 a month. Total borrowing will be just a little bit over $3,300 a month. Every single bill I have on the loan. And here's the number that makes it all worth it. My take-home pay is around $7,400 a month. Right now, most of the bills go to that. At phase 10, every dollar of it goes straight into buying more stocks. Nothing leaves for expenses. The loan handles everything. The dividends handle the interest on the loan, and the paycheck compounds month after month after month. That's the moment the whole thing becomes self-sustaining. Now, let me talk about a few columns. I have one that's highlighted right now, which is the coverage column. I want to explain it in plain terms. It answers one question: how many times over can the dividends pay interest on the loan? Not the full balance, just the monthly interest. At phase 1, 3.7 times over. At phase 10, 2.7 times over. Some people see that number go down and get nervous, but think about what's actually happening. At phase 10, I'm borrowing $3,300 a month. The interest on that is about $187 a month. My dividends are about $580 a month. So my dividends cover the interest almost 2.7 times over. I could lose almost 2/3 of my dividend income and still break even on the interest. That's the safety margin. The bills come from the loan, the interest come from the dividends, the paycheck builds the portfolio. The loop is the whole strategy. Now let's talk about the paycheck column. This column's a little personal because every phase I can see exactly how much of my paycheck stops evaporating into bills and starts building my future instead. Phase 1, $100 a month, freed, small but real. Phase 3 at 14K is around $345 a month freed, over $4,000 a year going into investments instead of expenses. Phase 5 at 30K, $608 freed, getting meaningful. Phase 8 at 80K, $1,100 freed, almost $14,000 a year that's being used to invest. Phase 9 at 112K, $2,800 freed. That's nearly 38% of my paycheck compounding instead of paying bills. Phase 10 at 145K, around $3,300 freed, combined with what I was already investing, 100% of my paycheck goes into the portfolio. Every phase is a level up. Every milestone means more money working for me and less money walking out the door. Now, let's talk about the risks. Now, let me talk about where it can go, because it can. The loan costs 5.65% a year. My portfolio currently yields around 5.33%, which means my dividends cover the loan interest on every single phase of the plan. If my portfolio ever drops far enough that the loan becomes too big relative to what my portfolio is worth, M1 Finance will probably issue me a margin call. That means I have to either deposit more money, sell more stock, or reduce the loan. Right now, no matter what the market is doing, selling stocks in a downturn is exactly what I'm trying to avoid. So preventing a margin call is the whole game. Here's how I stay safe. First, I keep my loan to value, my LTV ratio, at 12%. That means my loan is only 12% of what my portfolio is worth. M1 doesn't issue a margin call until you hit around 40% LTV. So even if my portfolio dropped 30%, I'm still well within safety territories at 12%. Number two, one of the ETFs I hold is SCHD. It holds companies that have paid and grown their dividends over decades. Dividend-paying companies tend to hold their value better in market crashes than pure growth companies. SCHD is my crash buffer. Third, a cash cushion. I keep enough cash on hand to cover 2 to 3 months of loan interest. If the market fluctuates and my dividends take a hit, I'm not scrambling. The phase system itself is also a risk management. By building slowly, I'm never overextended at any point. And by that time I reach the big phase, the mortgage, the daycare, school, I have years of experience running this system safely. Now, why one bill at a time? I want to come back to that because I think it's the most underrated part of the whole strategy. When I moved my phone bill to the loan at phase one, something changed. Not just my finances, in my head. I could see the plan working. I could watch the loan go out, the dividends come in, and the interest getting covered. It wasn't a theory anymore. Each phase does two things. It moves a bill, and it proves to you that the system works. By the time I get to phase 9 and I'm putting the mortgage on the loan, I'm not taking a leap of faith anymore. I've already watched this work for every other bill in my life. I know what good coverage looks like. I know how the numbers move. I know what to watch. That's the whole point of doing it slowly. The confidence I build along the way is just as valuable as the financial progress. So 10 phases, one bill at a time, going from $6,000 from when I started to the future of $145,000. That's the plan. TNT bill, TNT internet, energy, car insurance, subscriptions, mortgage. When I hit phase 10, I'll show you exactly the moment it happens. Every dollar on my paycheck going into the portfolio. That's the video I'm building towards. And based on my current savings rate and my portfolio growth, I think I'll be there in about 2 to 3 years. If you want to follow along in real time, subscribe. I post every single week with real numbers from my actual account. Current portfolio value, dividends received, loan balance, interest paid, all of that. Just truth. If you want to go deeper, comment, subscribe, and I'll see you on the next one.